Greetings, folks. This is DC Investing. I've reached financial independence, and I'm talking about topics to help others to reach financial independence. And the topic today is that the Fed has started to lower interest rates again. They just had their meeting. Rates on money market accounts are going to go down from about 4% to 3.75% right away. They plan to cut again in October and December. So by the end of the year, you're going to be earning about 3.25% from any cash that you have in money market accounts. And rates had been high enough to kind of make just holding money market funds look attractive. If you are trying to retire on what you've saved, if you had $1 million, you were earning $40,000 a year. By the end of the year, it's going to be cut to 32,000. So you're going to have to be defensive right now and start thinking longer term. The plan is you're going to not make as much in your money market accounts, and over the next couple years, the thinking is that there's going to be pressure on the Fed to continue lowering short-term interest rates, and that'll affect the payout that you're going to get for any of the cash that you have into your account. So what can you do about that? One of the thoughts is kind of take a look at some consumer staple stocks. They've been somewhat out of favor for the past while, but they do pay dividends, and some of them have a pretty decent dividend rate. So one of the thoughts is take a look at PepsiCo. Its ticker is PEP. As of today, it has a dividend yield of 3.8%. So you'll be getting a higher income rate by owning PepsiCo stock than you would by owning a money market account. So with any investment, you kind of have to be careful about the the status of the stock and what's going to be happening to it. So PepsiCo has kind of underperformed. The other one to kind of look at is Coke. It's somewhat underperformed over the last little while, and you kind of say, well, why is that? And it's because Coke is more of a pure play beverage company, whereas Pepsi has quite a few other things like snacks. And snacks are not something that everyone has to have in their life. And so there's a truck leaving over here. I don't know if you can hear that or not, but kind of loud where I am. So Pepsi has more in the snack business, and I think the sales have been kind of down somewhat over the last little bit. So, the stock PepsiCo is actually down over the last little while, so it could continue to go down. I don't know. To me, it looks like it's kind of has hit a floor, might be starting to trend up a little bit. But as people realize that, hey, we can't earn enough from bank accounts and money market accounts, they're going to start looking for other alternatives. And right now, PepsiCo's 3.8% dividend yield looks pretty good. And so you may get a bit of a tailwind from people who are looking for some safe income. Getting 3.8% is already better than the 3.3 or 3.75 from a money market account. So, that's something to consider. PepsiCo has a PE right now of 19. I think that's lower than it has been historically. To compare it, Coke, their ticker is KO. Their dividend payout right now is 2.9%. So by the end of the year, when money markets are down to 3.25, Coke's, almost 3% isn't that far from it. And so some folks may think, hey, money markets may continue to go lower. And if you get into a strong dividend payer, they may actually go up as people start looking for yield over the next while. The PE on Coke is 24 right now, so it actually is a more expensive stock than PepsiCo is at the moment. PepsiCo has a higher dividend yield because the share price has kind of come down over the past while. Something to note is both of these stocks, both Coke and Pepsi, are what's called dividend kings, which means they have paid and raised their dividends for over 50 years. So there are very few companies that have track records like that. And once a company gets to that state where they're a dividend king, they will try to do everything they possibly can to continue on that dividend streak, because they do not want to lose that. It takes a lot of effort to get up to that point. So most likely both of these companies are pretty safe in terms of their dividend. And so when you're kind of looking at what's the safety of things you're investing in, well, chances are both Pepsi and Coke will be continue to pay their dividend and raise it year after year. Now the raise is important because you got to keep your funds just ahead of what inflation is. You know, we don't know exactly what real inflation is. The government says it's somewhere between 2 to 3%, but it's probably more like 5%. But, you know, buying a company like Pepsi or Coke, hopefully your share price continues to appreciate over time. So you stay ahead of inflation. And as they raise the dividend each year, hopefully your cash flow kind of stays up with inflation as well. So those are some things you can do. Um, Interest rates are falling. Any cash that you have is going to earn less. You got to be on the watch out for things that will preserve your spending ability over the next long while. And Pepsi has a higher dividend yield right now than Coke does. Just, you know, might be something for you to take a look at if you need that extra spending power. So let me know your thoughts. What do you think about Coke, Pepsi, other dividend payers? What are you guys doing to protect your spending ability as the Fed lowers interest rates? Love to hear your thoughts. Like, subscribe. Thanks. Bye.